Hello investors, it's Stuart Cruz and welcome to Cruz Asset Management's chart of the day. It's hard to go without talking about the sell-off that we had just 3 days ago. We are having a rally today, but we had a strong sell-off for the last 3 days, trending down, and pretty much it's been the FAMANG plus Microsoft stocks. And so let's take a look at some of these things. Right now I have a chart up of the FAMANG plus Microsoft stocks and their sell-offs over the last 3 days, plus a little run-up today. If you're looking, we're down pretty considerably, double digits for Apple and single digits for some of the other stocks. And if you want to look at the market cap itself, the market cap is also down double digits for most of these particular names. So what does this mean? Is this part of a bigger sell-off, or is this just a normal pullback and we should buy on the dips? So I've been talking a little bit about the run-ups over the last year, and I think they've been a little bit lofty. So just to put this in perspective, this 3-day sell-off, if I change this from a 5-day chart to a 1-month chart, all of those names are still positive. So we haven't even given back the last 30 days worth of gains. All of them are still up, except for the one. Microsoft is down 1%, but pretty much across the board, they're still up. The market caps are still up across the board. But a little bit more interesting, let's go to a year-to-date chart. They're up huge. Apple, Amazon, Microsoft, all up in the 50, 60, 70% range. Market caps are up enormously. I will put PE ratios on here. Those things are also up on a percentage basis, very large percentage basis wise. Okay, so you're looking at prices up 76%, market cap up 77% for Amazon, and the PE ratios up 50, 60%. Is that backed by anything? Well, let's look at the earnings per share. If I add earnings per share on here, the only one that's really grown with any kind of good pace has been Netflix due to the lockdown. And then maybe you could say Facebook has also kind of justified its increase in market cap and price because it's grown at roughly a similar amount. But all the other ones have been much shy of their projected or of their growth rates and their expansion of their PEs and market cap. So really, it's only Netflix that seems to be here at 43% growth for the year or year to date, where their market cap and their prices were growing at about 50%. That's the only one that seems to be really growing into its valuation. I did want to point out one other thing just to put something into perspective. I'm going to bring up a chart on market caps here. And at the beginning of the year, the market caps of these FAMANG plus Microsoft or FAMANG names, they started all together. Here's a clustered bar chart, a stacked bar chart. All together, they started at about $5 trillion. And during the bottom of the lockdown, they came in at around $4.2 trillion. And they rallied up to $8 trillion from $5 trillion from the beginning of the year, and sold off and lost $1 trillion over that last 3 days. So we sold off to $7 trillion, but up from 5. So if you believe that this market is 40% stronger and it was worth the extra $2 trillion of market cap because of this kind of growth that we're seeing here, okay. But the real question is, if I'm going to change this chart to just kind of original charts, and let's really look at the PE ratios here of some of these names. They hit highs kind of in the 40s range here. You're looking at a lot of PE expansion in Amazon and in Netflix. I said Netflix has been growing into its numbers, so its PE ratios remain pretty constant. But Amazon has gotten all of its growth due to PE expansion has gone from 80 PE to 125. So that's up 50%. A lot of these other companies have gone up still in the mid-30s range, and they could easily trade down to a mid-20s range, could lose 30% of their value. So do I think this is a pause? If I had to be a betting man, I've been wrong most of the year as far as expecting this expansion. But the reality is there's probably a lot more risk to the market dropping than there is loss of opportunity cost of the market going up. So we're looking at some of these things. You could certainly see a PE coming down to mid-20s for most of these names because that's generally where they trade. And if I could add some, I guess I could do this on the fly and add the average PE lines to all of these so that you can kind of see where they're at. I know we're taking a little time here. Well, let's just see where all these average PEs are from a let's go with a 5-year standpoint. So Apple's average PE 17. It's trading at twice that. Amazon's average PE 200, but that's mostly due to some of this big lofty numbers up here, so kind of a more stable range. If I went over the last year, its average PE is 97, it's trading at 125. Microsoft's a little bit longer, its average PE is around 33, it's trading a little bit more reasonably. Alphabet, trading pretty reasonably, although expanded because of these names. Facebook, let's see what we're doing here. Below. And Netflix, well below, but coming down. So what could you see? I think you could certainly see Apple trading down to a more reasonable PE of 25, and that would basically cut its stock by a third. And some of these, since it's the biggest weighting in the S&P 500, you could certainly see that take effect across the board and pull the rest of the tech names down. So this is Stuart Cruz with Cruz Asset Management talking about the FAMANG plus Microsoft stocks. And is there more room to go? I think there probably is some more downside to go. Okay, so don't forget to invest with the odds in your favor.